In our strategy, we work with a 5-phase cycle framework. We are not predicting outcomes. We are tracking signals and sequencing as pressure builds. Yield curve behavior is one of those signals. Most people focus on yield curve inversion. Far fewer pay attention to what happens after it ends. Historically, that is often when instability increases. When the curve stops being inverted, many assume the danger has passed. In late cycle regimes, that assumption is often wrong. Yield curve re-steepening means the gap between short-term and long-term rates widens again. It happens after a period of inversion. The shape looks familiar, but the meaning can change. Re-steepening can happen because long-term rates rise with growth optimism, or it can happen because short-term rates fall as stress builds. Those are not the same outcome. On a chart, these moves can look identical. Under the surface, they reflect very different systems. The driver matters more than the shape. Re-steepening is often labeled as bullish. People assume tightening is over. They assume risk is safe again. In late cycle environments, the more common pattern is short-term rates falling fast, not because growth is strong, but because policy is reacting to stress. In our strategy, this is primarily a rates and credit signal. It also overlaps with liquidity and policy response. It is not a standalone equity signal. Stress builds in credit or funding. Policy shifts from restrictive to reactive. Short-term rates fall and the curve steepens. That kind of re-steepening does not signal resolution. It often signals something broke or is close to breaking. The system is transitioning, not healing. Historically, unstable periods often begin after re-steepening starts. Credit events tend to cluster here. Volatility rises rather than fades. Within the Builder's Lens framework, this signal aligns with late Phase 2 rolling stress and early Phase 3 policy reaction. Re-steepening is not a timing tool. It does not tell us when markets move. It tells us the regime is becoming more fragile. In our strategy, this is a confirmation signal. It confirms late cycle pressure is progressing. It does not confirm a crash on its own. When re-steepening is driven by falling short-term rates, long-duration assets often stabilize after volatility. Optionality becomes more valuable than leverage. Leverage-dependent structures struggle here. Late-cycle equity leadership often fades. Credit models that rely on stable funding come under pressure. This is where narratives become dangerous. Soft landing certainty often peaks here, but the plumbing is already under strain. If this kind of framework is useful to you, subscribing helps you stay grounded in signals rather than headlines. It keeps the focus on sequencing and risk as cycles evolve. This interpretation weakens if long-term rates rise sustainably, if credit spreads remain contained, and if liquidity improves without emergency measures. Absent those confirmations, re-steepening should be treated as a risk signal, not as relief. Quick note before we wrap. This is educational macro analysis only. It is not financial advice. This signal raises sensitivity to credit and funding stress. It tightens exit discipline, and it increases the value of optionality. It does not justify all-in defensive positioning. It does not invalidate late-cycle price strength, and it does not replace confirmation requirements. Yield curve inversion is the warning people notice. Re-steepening is the test that follows. When it is driven by policy responding to stress, the cycle is transitioning. In those moments, sequencing matters more than conviction. We do not need to be early. We just cannot afford to be late.